A year and a half. That is the precise duration remaining to reconfigure your holdings before the upcoming tectonic shift of capital from the uninformed to the prepared. Not a decade, not a half decade, but 18 months. Financial historians have meticulously analyzed fiscal credit expansions across multiple generations. The systemic warning signs were glaringly obvious right before the 2008 crash. The exact same red flags preceded the massive technology bubble burst. And as of today, every macroeconomic metric we can monitor is radiating a critical warning. We are currently navigating the seventh phase of an 8-part debt supercycle. This concluding chapter typically vaporizes 50 to 60% of standard investment accounts, yet your capital does not have to be a casualty. There exist only 4 specific asset classes that endure the approaching storm. Precisely 4. And throughout the next 20 minutes, this video will demonstrate exactly what they are, the logic behind their resilience, and the method for acquiring them before this opportunity vanishes silently and forever. Here is the reality that the mainstream institutions are withholding from you. These macro cycles manifest every 75 to 100 years without fail. The previous iteration took place during the turmoil of the 1930s and 1940s. And when these eras conclude, they do not dissipate gently. They resolve through a massive migration of wealth from those holding obsolete instruments to those positioned in resilient ones. We are going to identify those 4 specific pillars for you. We will explain why they are the solitary survivors when systemic structures fracture, and how to rebalance your net worth before the clock runs out. A cautionary tale, the price of inertia. But first, allow us to share a narrative that illustrates why this is the most vital information you will process this calendar year. Consider the documented case of a man we will call Thomas from the year 2006. He was a 54-year-old established architect. He had amassed $9 million through 3 decades of careful fiscal prudence. He was adhering to the standard financial playbook, a 60-40 split between equities and fixed income. He was paying a prestigious brokerage nearly $20,000 annually in management costs just to be told to remain invested. Independent financial analysts reviewed Thomas's portfolio during a private consultation. They shared with him the exact same warning we are providing you right now. We are at the tail end of a massive credit expansion. The housing market is dangerously leveraged. Financial institutions are concealing liabilities that no one can accurately price. A systemic shock is imminent. You must transition into the 4 vehicles that actually withstand these shocks. Thomas declined to act. His traditional financial representative insisted that the independent analysts were merely being sensationalist. They presented him with historical data spanning 40 years to prove that the market always rebounds. They claimed the underlying indicators were robust. They argued that broad diversification would act as a shield. They characterized those dire warnings as irrational pessimism. Consequently, Thomas maintained his existing strategy. 2007 arrived. The indices continued their upward trajectory. Thomas felt his decision was validated. His account value climbed to $2 million. He began mapping out a luxury retirement. His spouse selected a seasonal residence in a coastal community. They reserved a premium world cruise for the following autumn. Then the 2008 crisis struck. Thomas's capital plummeted by 54% over the course of 18 months. That $2 million fortune shriveled to roughly $1 million. Everything he had constructed over 30 years was severed in half. He was 56 years old at the time. His consultant urged him, do not act on emotion. Do not liquidate. The value will return. But Thomas lacked the luxury of time. He required that capital to experience compound growth for his imminent exit from the workforce. The indices did not return to their previous highs until 2013. He had reached 61 by that point in time. His financial projections indicated he was more than $800,000 beneath his necessary threshold. He postponed retirement until 65, then shifted it to 67, and eventually to 70. Recent updates on Thomas's situation from this past year are heartbreaking. He is 72 years old today and is still reporting to his firm. Not because of a passion for the craft, but because of economic necessity. The coastal home never materialized. The world cruise was never taken. His intended golden years were transformed into a continued struggle. And here is the tragic truth. Thomas was not an unintelligent individual. He was not acting recklessly. He obeyed every conventional directive. He placed his faith in the established authorities. He did exactly what the experts recommended, and it resulted in his financial ruin. The advisor who convinced him to stay the course retired comfortably at 58. That advisor currently resides in a luxury enclave and spends his days on the golf course. You must not become the next Thomas, the mechanics of the debt machine. Allow me to clarify exactly what is unfolding at this moment and why your window for action is limited to roughly 18 months. The global economy does not function by accident. It is a mechanical system, and that system is driven by three primary gears. These are productivity expansion, short-term credit cycles, and long-term credit cycles. Productivity expansion is easy to grasp. Are we generating more economic value per citizen this year compared to last? If the answer is affirmative, the economy thrives. If the answer is negative, we enter stagnation. Short-term credit cycles typically span 5 to 8 years. The economy grows as people access cheap money. They increase their spending. The marketplace becomes overheated. The central authorities respond by increasing interest rates. Borrowing capital becomes prohibitively expensive. Consumption decelerates. The economy enters a contraction. The central authorities then lower rates to restart the engine. This is the reason you observe a downturn every 7 to 10 years. It is not a random event. It is the machine resetting itself. However, there is a far larger cycle churning beneath the surface that most investors never detect. Over several decades, debt builds up like silt in a river. Sovereign debt, corporate liabilities, and household credit all accumulate year after year. Eventually, you arrive at a juncture where the total debt load becomes unmanageable. You can no longer afford to pay the interest. You cannot grow your way out of the deficit. You cannot refinance into lower rates because those rates are already at their floor. This is our current reality in 2026. The cumulative debt of the United States, encompassing public, private, and household, exceeds $90 trillion. The sovereign deficit trajectory alone has broken past every single mathematically sustainable threshold. That massive, unfunded obligation represents a crushing burden that heavily outweighs the nation's entire annual economic output. The central authorities now allocate astronomical sums every single year just to service the compounding interest on their previous borrowing. That is a larger sum than what is spent on national security. It is more than the education budget. It is more than the entire infrastructure spend. It is just the cost of carrying the debt. When interest obligations surpass defense spending for the first time in modern history, it is a signal of systemic failure. The burden has become unsustainable. A government that pays more to its lenders than to its defenders is a government nearing a total asset reset. The three exit doors. When you reach the terminal phase of a long-term credit cycle, only three outcomes remain. Outcome 1 is default. Governments, firms, and individuals simply stop fulfilling their payment obligations. This leads to widespread bankruptcy and the total destruction of paper wealth. Outcome 2 is restructuring. Debts are forcibly renegotiated. You were owed $100, but now you are told you will get $50 over a 20-year period. This sounds orderly until you realize that as the lender, you just lost half of your purchasing power. Outcome 3 is inflation. You print a sufficient volume of currency so that the debt becomes trivial in real terms. You owed $100,000 in 2020. By 2030, that same $100,000 is the cost of a dinner because the currency has been debased. This is a miracle for the person in debt, but a catastrophe for the person who saved. And can you guess which path the central planners always select? They choose inflation every single time. They will never call it devaluation in public. They will label it quantitative easing or economic stimulus or liquidity support, but it is simply the act of printing money. It is the creation of currency out of thin air to dilute the value of what is owed. And when they execute this, the funds in your checking account, the balance in your 401k, and the savings you have built over decades lose their value. They buy significantly less than they did before. Financial historians have scrutinized 500 years of global economic records. Analysts have mapped every major sovereign debt collapse since the rise of the Dutch Empire. The sequence is identical every time. In the 1930s, it wasn't just the equity markets that were decimated. Sovereign bonds failed. Corporate debt experienced a mass default. Equities plunged 89% from their highest point to their lowest. The only individuals who preserved their lifestyle were those who held four specific asset types: physical bullion, enterprises with pricing leverage, short-term sovereign bills, and fertile agricultural land. In the 1970s, the cycle returned. Fixed income was incinerated by rising prices. The 10-year Treasury lost 60% of its actual purchasing power in a single decade. Stocks remained flat for 10 long years. But when you account for inflation, which was moving at 8 or 9%, the real value of stock portfolios dropped by half. An investor who bought in 1968 didn't truly recover until the mid-1980s. That is 13 years of zero real progress. 13 years of watching your future evaporate while experts told you to stay the course. Conversely, four specific assets skyrocketed. Gold climbed from $35 to $850, a 24-fold increase. Companies with pricing power, specifically in energy, saw their income rise by 700%. Short-term bills protected the principal and provided flexibility, and productive land doubled or tripled in price. The pattern is 100% consistent. When debt cycles expire, paper wealth burns. Only four specific categories hold the heat. The hidden drain of the balanced portfolio. Let us examine the hidden mechanics of this destruction, focusing on the illusion of the modern balanced portfolio. Many investors only realize this harsh reality far too late, usually years after a great financial shock. The traditional wealth model relies heavily on a rigid split between equities and fixed income. This conventional structure is entirely dependent on an environment of stable consumer prices and predictable central bank policy. When sustained inflation enters the systemic plumbing, both stocks and bonds often collapse simultaneously. A lifetime of disciplined capital accumulation can be secretly eroded without a single market crash actually making the evening news. The nominal numerical values on your screen might look perfectly fine, even while your true purchasing power plummets. If the currency debasement runs at 8%, a portfolio returning a standard 5% is actually bleeding massive amounts of wealth. The average retail investor is completely unequipped to process this invisible mathematical confiscation. They obsessively check their brokerage applications, trusting that the digital balance reflects their actual financial security. They are fundamentally measuring their lifelong success with a broken economic ruler. The purchasing power of those paper gains enters a rapid, highly destructive, and irreversible downward slide. The historical data demands that we finally acknowledge and understand a very hard and uncomfortable reality. The actual danger of blindly following safe, conventional wealth management isn't just theoretical underperformance on a spreadsheet. It literally costs you the most valuable years of your future independence. It destroys the foundational financial security that you traded your physical labor to build. It is the trauma of realizing your retirement was systematically hollowed out because you placed your absolute trust in a flawed system. If most historical victims could go back, they would gladly trade every cent of paper profit for the absolute serenity that comes from owning actual, tangible safety. Do not let this silent mathematical deception become your ultimate story. The four pillars of survival. 1. Physical precious metals. The first truly secure position is physical bullion. This means gold and silver that is within your direct control. Not a gold tracking fund, not a mining stock, and not a digital certificate. Actual metal you can touch. Here is why this is the anchor of your future. Throughout the history of civilization, every time a paper currency fails, gold stands tall. It is the ultimate insurance policy against the arrogance of central planners. In the 1970s, while inflation was eating the dollar, gold went from $35 to $850. An individual who moved $10,000 into gold in 1970 held $240,000 by 1980. An individual who left that same $10,000 in the stock market had roughly $12,000 after adjusting for inflation. In the early 2000s, when the credit bubble burst, gold rose seven-fold. Even in 2025, gold surged by 70%. Silver rose by 140% in that same window. The market is already beginning to price in the death of the dollar. Physical gold should constitute 10 to 15% of your liquid net worth. You store it in private, high-security vaults across different countries. You hope you never have to sell it. But if the dollar loses half its value, that gold doubles in price while your paper assets are burning. It is not an investment. It is a shield. Two enterprises with pricing power. The second pillar is owning businesses that possess pricing leverage. I am not talking about broad index funds. I am talking about specific companies with three traits. First, they can increase their prices faster than the rate of inflation. Second, they produce real cash that you can live on. Third, they own physical assets or patents that retain value during a currency crisis. Think about companies like Procter & Gamble or Johnson & Johnson. If the cost of making soap goes up 20%, they raise the price 25%. People might complain, but they do not stop washing their clothes or treating their wounds. That is pricing power. You should allocate 30 to 35% of your capital to these dividend aristocrats. These are companies that have raised their payouts for 25 consecutive years. They have survived every war and every recession of the last century. 3 short-term Treasury securities. This may sound unexciting, but it is your most strategic move. I am referring to 90-day to 2-year Treasury bills yielding 4 to 5%. This is your ammunition for the crisis. When the crash happens, cash is king because everything becomes cheap. In 2008, high-quality debt was selling for 60 cents on the dollar. If you had liquid cash, you made 60% in a year just by buying the wreckage. Keep 20 to 25% in these short-term instruments. It won't make you rich, but it keeps your capital safe and ready for the moment of maximum opportunity. 4 productive real assets. The fourth pillar is land and infrastructure that generates income. Farmland, essential rental units, or infrastructure funds. Things people need regardless of what the stock market does. You cannot print more farmland. You cannot manufacture a prime rental property out of thin air. In every historical crisis, real assets hold their value because they produce something tangible: food and shelter. Allocate 10 to 15% of your holdings here. For most, this means specialized real estate investment trusts, REITs that own farms or essential medical buildings. The systematic transition plan. Most people will watch this, agree with the logic, and then do absolutely nothing. They will wait for a better time. But in 18 months, the better time will be gone. Here is your 4-step algorithm for repositioning. Calculate your runway. If you are within 10 years of retirement, you must move now. If you are younger, you can move over the next 12 months. Liquidate the fragile, sell the speculative tech stocks. Sell the crypto coins that have no utility. Sell the growth funds that have no dividends. Do this first. Build your buckets gradually. Do not move everything in one day. Month 1, buy your first gold coins. Month 2, buy your first dividend aristocrats. Month 3, open a Treasury account. Average your way into these safe positions. Ignore the mainstream noise. The television will tell you everything is fine. Your friends will brag about their tech stocks. Ignore them. You are playing for survival over the next 75 years, not the next 30 days. The final decision. We are currently in the 7th stage of the debt cycle. In 6 to 12 months, the 8th stage, the reset, will begin. By then, the exit doors will be crowded and the prices for safety will be astronomical. The people who act today will be the ones who buy the world tomorrow. The people who hesitate will be the ones who lose their future. It is that simple and it is that brutal. Close this video. Open your brokerage account. Start your transition today. Because in 548 days, you will either be the person who prepared or the person who is being Thomas. The choice is yours. Make the right one.